Hi there, thanks for tuning in. I wanted to do a quick session on bonds versus bond funds. Right now is a fantastic time to start a business or to grow your business because interest rates are so low. You can buy homes for 4.5%, sometimes less if you're doing a 15-year loan. And in addition, also if you're starting a business, it's easy to get money. That's why you're seeing a lot of startups right now because money is relatively cheap. But it looks like they're going to continue to raise interest rates, probably also in March. So I saw a recent article written by another company, but didn't cover, they talked about bonds versus bond funds, but they kind of skewed it towards bond funds over the long term, but they didn't factor in things that can affect people on an emotional level. So I wanted to cover that real quickly with you. Thank you for tuning in. So just be one sec. Okay, so first, bonds versus bond funds. I'm going to cover bonds. So I'm going to give a visual representation of what a bond is, my visual. So you start with a set principal amount of the bond. It's $1,000 typically, it's 1,000, and then it's a period of time. Let's say 10 years in this example. So you start with $1,000, you end with $1,000, and this coupon will be kind of where today's rates are, maybe a little higher for this example, 3%. So you're getting 3% for 10 years. On $1,000, it'd be $30. On $1 million, it'd be $30,000. So that's great and all. So what happens if interest rates go up? So they go from 3 to 5%, let's say, so 2% increase. Certainly possible. Normal rates are somewhere between 5 and 7% over longer term periods. So if that happened, that means this bond, to pay a new buyer 5% if someone wanted to sell it, it would have to be marked down from $1,000 to $600. So that's if you wanted to sell it right then. $600, boom. I want money, whatever I want to spend on something else. So that's a 40% decline. But the cool thing with a bond is, as long as you hold it till the end, the issuer guarantees you your principal back. But you have to hold it to the end. So that's different than a bond fund. So, and let me demonstrate how that's different real quick. Fund. I apologize for my poor writing in advance. So bond fund. So bond fund is much bigger. It's pools of investments. And just draw a big circle here. That's an ugly circle. Let's make it a little better. All right. So bond funds have lots of bonds all over the place here. And let's say this is the same thing. It's about as a 10-year duration, and it's at 3%, approximately. Just apples to apples, kind of. In this example, so starting with 1,000 and with 1,000. So what happens when pools of investors are worried? Interest rates are going up, most likely. Yellen's probably going to raise, I'm guessing, another quarter point the next time the Fed meets. So what's going to happen? So this bond, let's say rates go up, this fund drops 5-10%. Really nothing yet, but when she raises them again, another 5%, you may get some investor panic. So even if you hold, other investors may want to sell. They're like, oh, bonds, you're going to hear CNBC going, oh, there's bonds, got to get out of bonds. It's the worst thing ever. And so people start selling these bonds or putting pressure on the fund because they're going to put sell requests in. The manager's going to have to sell. He can't hold when he has to generate cash. So you lose that definition, 10-year, 3%, and you're forced to sell, or the fund is forced to sell. But you as an investor, you basically can get a realized loss because of that. And that's the difference really between bonds and bond funds, is bond funds don't have a definition of the coupon is 3% and the duration, it's 10 years, because there's many different bonds in the fund and it can be pressured from outside buyers. So in today's market, it's better for your fixed income exposure to be actually invested in specific bonds rather than bond funds, especially when you consider the rising rate environment. I hope you found this video enjoyable and educational. Feel free to like it, and thanks again for your time, and make it a great day.